right, good morning, everybody. Happy Friday. Today is March 10th, and we got a lot of news to go over. So, we got Silicon Valley Bank down 80% over the last about 24 hours. If we look at ticker SIVB, well, doesn't look like we have any stock related, but yeah, this one is down from $267 to currently trading at $82. So down a whopping 69%. Nice. So the reason why this bank is down so badly is because they were forced to liquidate something along the lines of $20 billion worth of bonds, as well as tens of billions of dollars in equity, I believe. Let me check to see. Been following this story over on Twitter. There's a couple names that have been pretty good for it. Let's see if I can find them, hopefully. Silicon Valley Bank. So basically the fear here is that this is going to spread among many smaller regional banks, which is kind of what Silicon Valley Bank is, but it's also a pretty large bank. This has done a lot of venture capitalism and funded a lot of the companies that we know, but basically they ended up selling $117 billion of securities that were yielding them. So this is the treasury yield that they were getting, 1.56 to 1.66%. And now the treasury rates are along the lines of like 4.5 to 5%. So whenever the yields are going up, the price of the bond that they were buying over the last couple of years has gone down. So they had a crap ton of unrealized losses from these, and now they're finally realizing these losses and liquidating all the bonds that they bought in order to come up with cash, just to come up with the reserves that they need in order to, if everybody decides to take all their money out, they need to be able to back that up, essentially. But SPY currently trading at 390. Another one to watch for today is KRE. So this is a regional bank ETF. This one's already down 5.1% today. So again, this could be contagious across many of these smaller regional banks, and not just with Silicon Valley. We saw another one, I believe it was Silvergate. They got caught up in a bunch of crypto buying, which ended up hurting them. But yeah, there's some crazy shit going on in banks, and lucky me, I ended up taking a put option, Leap's put option for Bank of America, which has been printing me a good amount of money the last couple of trading days because of this. Yeah, I do think that it could be another bloody day. We did have the unemployment report. That is okay. So, it's not just strictly bearish. I would look at the economic calendar and look at the recent unemployment data. So the wage gains are starting to slow down at 0.2%. So if you annualize that, that's about 2.4% year over year if it continues to be at that rate. And then the unemployment rate came in at 3.6% versus 3.4% at the last reading in January. So slight uptick in unemployment, which means that rates are actually coming down. If you look at the 10-year, it's currently below 3.8, down from 4.0 just a couple of days ago. So that's a significant move down for treasuries. And then you have the dollar index also managing its way down to 104.50 right now versus that high the other day where we got to 105.80. But it really depends on the narrative here. Usually you would see a rise for SPY whenever the dollar goes down. But that's whenever we have the inflation narrative. When we have the recession narrative or systemic risk narrative, like we saw with the regional banks and Silicon Valley, whenever the dollar goes down, stocks will go down with it. So do beware that that correlation could change depending on what the narrative becomes. But yeah, we're definitely seeing a sell-off in the dollar. We're definitely seeing a drop in the 10-year Treasury rate. And rates across the board are actually coming down pretty significantly. If we look at the 2-year yield, let's see. Currently at 4.6767. This was as high as 5.005 or something like that the other day. So this has definitely come down, and the reason why rates will come down is because there's more people that are buying into bonds. Bond prices will go up because people are buying the bonds, and then they get paid less accordingly because there's more people in that bond to pay out now. So they get less of the share from that bond, essentially. So whenever people are buying bonds, the yields will come down, the price of the bond will go up. And if we look at even shorter term, say the 3-month yield, this one actually dropped significantly too to I think 4.7 or so. 4.9 actually. And this is down from, I think it was like 5.07 or something like that a few days ago. Actually 5.03. The peak was at 5.07, but for a very short amount of time. So yields are coming down. People are pouring more money into bonds because of the fear of systemic risk. So all the high net worth individuals basically are pulling their money out of these regional banks or even larger banks and putting that into a safer place, into treasury bonds, because with regular bank with FIDC insurance, you're only going to get, I think, 250,000 or 350,000 covered. Whereas with a treasury bond, you can buy, millions of dollars and have it, in full faith and credit to the United States. Unless, of course, we end up defaulting, which could be an entirely different story for another day. But for right now, that's what's happening with the markets. Right now, SPY is below 390. Almost at that trend line. The mother of all trend lines that everybody has been watching. So pretty chaotic day to say the least. Pretty chaotic last couple of days. My account luckily is up $350 because I took on quite a bit of short positions with Bank of America, printing me another $210 today. Might actually exit that position pretty soon, probably the next, either today or on Monday. I think the fear of systemic banks could fade pretty quickly, but if we see another bank getting hit, another regional bank, then that could be bearish for the market continuing. Call credit spreads for QQQ are basically worthless at this point. I've realized all $187 of credit for it. I'm glad on that. And then my UVXY shares, these are up 2% today. I think I'm going to hold my UVXY shares, but close out of my bank puts. I think that's probably the best way to manage out of these positions. So let's see. And then I have a SPY put debit spread, assuming that it's going to be below 393. It's at 390 right now. I'm surprised these aren't going for a little bit more expensive. But it still does have, a week until expiration on the 16th. So I could hold this and realize more profit out of it, but we'll see. I definitely want to get out of these. So I'm up $400 for this Bank of America put option. It's trading at $29.25 right now, so Bank of America is getting slaughtered again. Yesterday it was down 5%. Today it's down another 4%. So yeah, the regional banks are really having an effect on even the larger banks, with regional banks down 5.5% today. Bank of America is down another 4%. JP Morgan is down actually only 1%, surprisingly. And then if we look at, say, Wells Fargo, another big bank, obviously, down 2%. So Bank of America is actually getting hit the worst, interesting enough. I do think that this might be close to a new yearly low. Yeah, that is actually a new yearly low. So I am going to get out. That's when I had planned to get out of this trade, whenever it hit a new yearly low. So I'm just going to follow my plan and hop on out of these trades. So the bid is at 805. The ask is at 9. I would probably get filled, I would think, at like 820, 825, but we can always check not Robinhood, but Aries to get a better idea of what the bid-ask spread really is. Because Robinhood will never tell you what the bid-ask spread is. They won't give you an accurate representation, but Aries usually gives you the best. So if we go to Bank of America, this was a Leaps put option expiring all the way out in January of 2025. So I had a shit ton of time that I bought myself for this option. And I needed that time for sure because I've been sitting on these options since, what was it, December, I think I bought them. Actually, no, back in October of 2022 is when I bought these. So I've been sitting on these options for a very, very long time. But now they finally pay out. Let's see. My strike price was 37. We chose the puts. So the bid is, that is not, that's June of 2025. Okay, I need January of 2025. Whoopsies. So January 2025, 37 put. I hope the bid-ask spread isn't wider on Aries. That would suck. God dang it. Gotta get rid of one of these. I don't want any of the Junes. Alright, I gotta refresh the page altogether, I guess. Maybe I should just make the switch over to Aries so I don't have to go through this process. Probably a better idea. But, let's see. Alright. So they're telling me 805 at the bid, 850 at the mid, and then $9 at the ask. So they're giving me the same bid ask spread. I'm going to try to get out at 820. Actually, let's go higher. Let's go 835 each for 3 of them. I'm going to close out of all 3. Yeah, and I ended up getting filled for all 3 of them. Sweet. Good stuff. So let me put that in the Discord. Nice little $400-ish of profit that I got out of the trade. I will take it. Took a while to realize it, but realized it nonetheless. Closing options alert. Just took profits on the Bank of America Leaps puts expiring in January 2025. $37 strike price. I'll get the exact date though. Don't want to screw anybody up there. Exact date is January 17th, 2025. 1/17/2025. And let me see if I can find this in my history since it's been a while. Bank of America Leaps put. Crap. Maybe if I could just type in Bank of America, I can find it. I'm just not able to find this. Let me see what date I found. What date I opened it on. Opened this on October. No, before October 14th. 3 contracts at 22. So I found the price that I opened it at. Just need to find the date. I know it wasn't March 17th of 2020. That's way too early. Alright, well. January 6th of 2022. That's when I bought these. Okay. Hmm. All right. Well, I'll just take the messages here. Originally opened them at, let's see, 7:20 each on October 17th. All right. Originally opened 3 at 2505 divided by 3, 835. Wait a minute. No, 720 each. So, got out of those. Looks more like a gamble. Let's see. The mother of all trades. Bonds are making my brain hurt. Yeah, bonds are interesting dynamic for sure. But I mean, the dynamic now is that people are piling in to bonds because they're afraid of the economy crashing and a bank run, drying up the liquidity in the banking industry. So now they want to park their money into bonds instead of holding it in cash, at least for the people that have more than FIDC can insure, at least. What's my target for SPY? I'm looking at the mother of all trend lines for a bounce, possibly. We are getting close to it. Currently trading at 388.25, and that trend line's at 388.01 or so, roughly. So if we cross below that trend line, I think that could fuel the sell-off a bit more. But I think that it really depends on what we see out of this one right here, out of KRE, which is down to 8% today. So it's just getting slaughtered after the news for the bank or Silicon Valley Bank. I keep wanting to say Silver Bank, which also got screwed over. But yeah, it's Silicon Valley Bank is the one that's really in deep shit right now. But the VIX is at 24 now. Jesus Christ. I do have UVIXY shares to go along with this. But yeah, I'm watching that trend line. I think it could bounce, but if this if that KRE continues to sell off, I think we could break right through it. I think people could easily just move their money over. But I do think that, the larger banks, say Charles Schwab, although Charles Schwab dropped like 13% yesterday and 9% today, so they are getting hammered. But I do think that the larger banks do have a little bit more cushion to, take on those losses from the bond prices going down. Just because there's more people that use the banks, they have more cash and reserve to kind of buffer that volatility. So Schwab and Bank of America, all the larger institutional banks, I think that they'll be okay for longer. But, this could spread into becoming a larger thing where, you see the regional banks, people starting to do bank runs on them, taking out all their money. And then that transitions to larger banks, maybe like Bank of New York Mellon or something like that. And then that would transition into, bigger banks like Bank of America, JP Morgan. But, it's a domino effect. It's how far the dominoes will go is the question. But SPY just went below that trend line. So that is pretty deadly, I would say. And the VIX is at 25. Jesus Christ. Murderous today. Sounds like we got some Black Friday sales coming in 2 seasons early. I wouldn't want to be buying stocks right now, personally. I've been buying stocks, dollar cost averaging, which I'm probably still going to do just because I have lots of cash left over. But I wouldn't be buying just because of, SPY down 3% in the last 2 days. Especially trading at 387, 388 right now. I still think that this has a good ways to come down. My next price target would be the 380 price level based on the Fibonacci levels, but that could take, another couple of weeks between now and the next Fed meeting for that to play out. Do I think now is a good time to buy Uber? Possibly. Uber has a lot of cash on hand, which I like about the company. They are cash flow positive if you disregard the issues that they had with legislatures overseas. So I do think that they could be a decent buy. They're down 3% today. Not really unusual. And I would say, yeah, $30 or roughly $30 is a decent buying opportunity for them. But I also want to see like the continuation of their earnings being positive. Like last one came in at 29 cents. If you extrapolate that out, say if they do 30 cents a share for the next 4 quarters, or doing 120 earnings per share each year, and they're trading at 31, so their earnings per share is still relatively high. I don't know how saturated the market is and how much more they could grow, but they have been expanding into, food and delivering other kind of services. So they do seem to know what they're doing when it comes to expanding business. So I would say $30 is a decent opportunity to start like dollar cost averaging, but I would do it very slowly, personally. Like I've been dollar cost averaging into the stocks that I like 1% of my cash balance each week. Right, I have $40,000 roughly in cash, and I've been buying $400 worth of stocks each week. That way, I can spend that same $40,000 cash pile if it stays the same for the next 100 weeks or 2 years. But yeah, we do have a report coming out at 10 a.m. I wonder if that could shift the markets. I think it's another employment report, if I remember correctly. Oh no, we're done with employment reports today. No other reports besides this stuff at the bottom at 1 o'clock, which doesn't move the markets. So yeah, interesting stuff. This is all we got today. These QQQ call credit spreads are at max profits, so I'm probably not going to touch them. The put debit spreads, on the other hand, I do want to contemplate getting out of, since they're trading at 60-ish right now. Let's see, these are up by 200. I think I might be able to get out at 58, possibly. Which I think I'd be fine with getting out at 58. Yep. All right, so let me get out of that one. And then the call credit spread for QQQ should basically just be max profit unless we get some sort of crazy rally by the end of the day. But considering there's no more news coming out, I think we're solid. Closing options alerts. Premium just took profits on the SPY put debit spread that is expiring next Friday, I think, on the 16th, or that's actually on the Thursday. 316, and I ended up closing them at 58 each. Strike prices I chose were 393, 394. I feel like I got cheated for the strike prices I chose and what I got out at. I feel like these should easily be going for more than 60 a piece, but yeah, it is what it is. 393, 394. All right, and I'm glad that I got out of those iron condors that I had open the other day too. That would have been really bad holding those into yesterday and the sell-off, but originally opened 7 of these at 32. So 58 minus 32, 26 times $7 is 182 profit there. All right. Good stuff. Now let's check on UVIXI, my last large position that I have open. Currently trading at 544, up 5% today. UVIXI is very strange. So UVIXI is supposed to do what the VIX does, multiplied by 1.5%. Since it's a leverage ETF, it should perform the VIX times 1.5. But we're not seeing that, which is really kind of strange. So the UVIXI is up by 5.75%, whereas the VIX is up by 5.25%. So if you multiply the VIX times 1.5, you would get 7.5 to 8% for UVIXI, but we're not seeing that, which is very strange, to say the least. So I wonder if they're not managing UVIXI correctly or what's going on here. But I still have my shares. I bought them at like $7 ish a piece, maybe a little bit less. So I still have a lot to make up for. But if this KRE keeps unraveling, then this could get pretty bloody towards the downside, and VIX would go up a lot. I've seen a lot of options traders buying a ton of the VIX, like millions of dollars worth. You saw CBOE volatility. Let's see. This options trader bought the 30-32 call spreads, 85,000 of these, and then 83,000 expiring in June with a 32 and 34 strike prices. So there's a lot of traders that are assuming VIX is going to go up by a ton, but they also probably got in, before this huge rise that we already saw. So these people could be taking profits already, right? The VIX is getting pretty close to the 200 moving average line. So you might see some profit taking on the VIX, but right now, it's up 5% after being up, what was it, like 10, 15% yesterday? I think it was along the lines of 15%. So VIX is definitely rallying like hell. But SPY is coming down 0.75%, so not really seeing much movement out of SPY. Considering the 2% drop yesterday, 0.75 is just a drop in the bucket. But cumulative, this is down from 401.50 down to 389. So $12, 3% over the last 2 days, or last 24 hours, I would say. But we did get some support again at that trend line. The line ended up being the bouncing point for SPY. So we'll see if we hold it. I know we're below the 200 moving average for sure. So that's probably going to be the fight over the next couple of weeks. I think that's a shorter. Let me see. This is a 252 moving average line, actually. Let me change it to 200. This one is at 393, so we could see, $2, $3, $4 rally between now and maybe the next CPI report. So that could be a position to take on with this huge sell-off that we're getting today. But really depends for KRE and the regional banks. If they keep selling off, I imagine that SPY is just going to keep getting slaughtered with them. But yeah. Need more people to stay home and be day traders. Too many people working and not paying their bills, and paying their bills. No good. Need more poor people. Yeah, in order to bring inflation down, everybody needs to lose their job. The senator from Kentucky, I don't know if I talked about this yesterday, but he was saying that for every 2% drop in inflation, it causes 3.5% increase in unemployment. So if we try to get down to 2% inflation from 6% based on the CPI right now, that means that we're going to go from 3.5% unemployment to 10%. And that's based on historical data. I think that this is pretty, hard to say that it would just play out like history has. But, just going based off the data, you could see 10% unemployment at some point. I would say it would take a good few years at high interest rates in order to feel that, though. But hard to say. There will be a balance, may pause in the next meeting. Yeah. Let's see what the odds for 50 basis points. I know the odds for 50 basis points ended up flipping to the downside. So people are estimating the 25 basis point rate hike, 72%, and now 30% chance for 50 basis points at the next meeting on March 22nd. But, this could always flip to the other side depending on how CPI comes out at the next reading. I'm doubtful that they would pause at the next reading just because regional banks are going belly up. It didn't seem like Petro Powell had really any concern for regional banks whenever he was testifying in front of Congress. So I'm doubtful on that. And if you do drop rates, pivot, or pause rates, if they do take a more dovish stance, you're just going to get a reignition of inflation, just like you did back in the 1970s. Let's see. But yeah, I do think that we could get a decent rally before the next CPI. Currently, we're trading at 390. I would think that we would probably retest the 200 moving average before that. But let me see. The next CPI report is, I think, on the 14th, if I remember right. Let me check the economic calendar. If we go to next week's data, that's not next week. This is next week. Yeah, it's coming out on the 14th on Tuesday. So I would say my best guess will probably come back closer to the 200 moving average at 393. Currently, we're trading at 389, so there is a little bit of upside that we could expect before the next inflation report on the 14th. So that's on Tuesday. So we have Monday and Tuesday to watch this appreciate. And these are going for currently 51 cents a piece. So that's kind of expensive in my opinion. I usually try to get these spreads for like 30 cents a piece, but 50 cents is just too much for me to pay in my opinion. 1-to-1 risk reward ratio for that, assuming that we'll go back to 200 moving average, isn't worth it. Let's see. If we extend our expiration date, that lowers the implied volatility because more people are focused on the short-term expirations. So we might be able to get something cheaper if we go with a later expiration date, possibly. If we go with the 16th expiration, that's still 50 cents. A little bit lower, actually. But it's very interesting dynamic how the longer you set your expiration date, the lower IB becomes because everybody's focused on the short-term 0 data expirations, and then like specific dates like March 14th with a CPI report. You can get cheaper options if you go with different expiration dates than that. So something to pay attention to. What do I think of dollar cost averaging into XLF for the long term? I probably wouldn't do it. I wouldn't want to invest in banks for the next probably couple years until interest rates go back low. PPI is on Wednesday and CPI is Tuesday. IWM was a real tell-all yesterday. IWM started dropping before everything else, which was very odd whenever SPY was still managing to be up. I think IWM was down like 0.5% or something like that. But IWM was kind of the snitch before everything else fell. For some reason, my charts aren't pulling up. There we go. All right. Trying to find a decent opportunity here, but at 393 put debits or call debit spread is just too damn expensive. Oh, was I? Hold on. I think I might have had the wrong side chosen. No, they're still going for 50 cents. 44 cents at the bid, 48 cents at the ask. I'm not willing to pay $48 a piece for that. Somebody else can pay it, but it ain't gonna be me. I wonder what if we take the downside trade, if that's better. If we assume SPY will go below the trend line at 388, that one's actually cheaper. So more people are betting on the upside, I guess, than the downside. So if you assume SPY is going to drop by $2 from where it's at right now, you pay $44 for the March 14th expiration. Whereas if you assume SPY is going to go up by $2 to 393, you're paying 48. So you're paying like an extra 10% to take the call side right now versus the put side. Interesting enough. So that means nobody's buying puts for the CPI report. Ulta? Let's see. Oh, I forgot about my Ulta trade, actually. Currently trading at 530. My assumption is going to be below 540. Currently trading at 530. So it did end up recovering. They did have a they had a good earnings report, I would say. Beat on earnings, beat on revenue. So they ended up just trading back to where they were yesterday at the highs. Currently at 530. My Ulta trade is going for $25 a profit, actually $50 a profit. I'm willing to take that. I don't want to take on the risk of markets recovering next week, Ulta going up with it. I would rather get out of that trade now than wait for it. So let's go to Aries, get a good bid-ask spread for it, and close out. I was wrong about the trade, but still ended up making profit. So happy about that. Ulta options, it's expiring for next week, the 17th. So I gave myself that extra week that I needed. And I'm assuming that it's going to be below 540. And I just bought the 545. Right now the bid is at 140. The ask is 120. I ended up opening these at 198. So Wait, let me check the bid ask again. 150, 110. Okay. I'll try it for 140. Nice little $50-ish, $48 profit that I'll get out of that. No? Okay. I'll have to replace the order then. 1.5. It's going for 130 now. All right, I'll try to close it at 145. And then if that fails, 150 will have to be the order. Nope. All right. There's probably just minimum volume on this, so bid-ask spread is wide, making it harder to get out in and out of the trade. Not even getting out at 150. They are relentless in taking my money. The ask is 140, the bid is 140, so this should get filled, but Robinhood says no. There we go. So nice little $48 in profit that I got out of that. Even though I was wrong about their earnings, I'll take it. The market's coming down probably helped me out there. I imagine if the market's rallied on the unemployment report, that probably would have gone south on me. But lucky me, $50 profit or $40 profit. Closing options alerts. Premium. Just took profits on the Alta. Strike prices were 540, 545. Call credit spread expiring next week, the 17th, 317 at 1.5. And I assume that it would be below 545. 540 and 545. Originally open at 198 too. So nice little 48 profit. Wait. Yeah, 48 profit. Math is hard. And that could end up, going to those new highs again, depending on how the markets trade for the next week. The earnings was good at 668. The expectations was 564, so a huge beat on earnings per share. Revenue ended up coming in slightly higher too. Let's see. $3.23 billion. And then the expectations, I think it was like 3.05 or something like that. Let me check. I wrote it down in the chat here. $3.01 billion. So they beat revenue by $200 million, which is a pretty sizable beat for both earnings, both revenue. So stock is going up now. Not too shocking. 300,000 volume on Alta. That seems, well, I mean, given that it's a $500 stock, that's actually pretty sizable. But let's see, their last earnings report, they got all the way up to, let's see, volume at 1.5 million. So might be seeing a reduction in volume. No, the price of the stock also will affect that too. Being so much higher, there's going to be less shares traded at a higher price. Make a video on how to close a straddle option. I wonder if I've made a video on straddles, but basically the way that you close a straddle is just the opposite to how you open it. So if you're doing a short straddle where you sell two of the same strike price and put in a call, You would buy those strike prices back, and then if you buy a straddle, buy a call and a put with the same strike price, you would sell those back to the market. Biden is coming in at 10:45 for the jobs report. That'll be interesting. I wonder how he's going to spin that narrative. Well, he's just going to focus on the number of jobs that were added with the non-farm employment change. He's definitely not going to focus on the 0.2% uptick in unemployment, because that would work against his narrative that he's trying to push. All right. So, I do still want to open a new trade. Gold is doing well. At 173 right now. My gold leaps are only down 200 at the moment. Could be worth selling a covered call before the Fed meeting on the 22nd, or even before the CPI report coming out next week. I still think that there's probably more inflation to come, even with the wage inflation slowing down for the month of February. The amount of credit card spending is going up, so that's just going to add to the inflationary pressures. Even if people are getting paid slowly less money, I think that people are going to overspend on their credit cards and then just wait to pay that off. But let's see. That gold leaps recovering a bit today. If I set an expiration, say 30 days out, poor man's cover call, I would go, I'd probably want to get paid around 200, so I could sell the 175 strike price. 42 delta, it's too high for my taste. I could get paid 100 at the 178 strike price with a 26 delta. That's okay. I think with the recession narrative building up, though, I think it's probably best to just keep on holding the gold leaps instead. I think that's probably our best bet as of right now, until either we get more clarification on Silicon Valley Bank, or something to turn that ship around, with KRE down 4% today. It is actually managing its way back up from the lows this morning at 48.44. So and then Bank of America is trading at 30.06. So I got out at a pretty good time for the Bank of America leaps put. VIX is almost at 24. It is wild, wild west out here. What's up? Okay. Yeah, sure. Here. You gonna bring her to me? All right. So mostly watching the VIX right now. Still going higher at 24 almost. Kind of tempted to sell part of my UVIXY position. These are going for 553. I still bought them at 719, so I would be taking a loss there. And I continue to sell at that 550 level. I've sold it a couple times before at that 550 level. Yeah. Should I sell my UVIXY? What do you think? You don't care. You want Dogecoin. All right, yeah. I'm going to sell 5% of the position, so I have 400 shares, so 5% would be 20 shares that I'll sell out of. Not $20, but 20 shares. Give myself another $100 liquidity. Oh, poor thing. All right. Yeah. Post that to the Discord. I wonder if I can type in the shortcut here. Hopefully. Nope, no shortcuts. Sell alerts. Just sold 20 shares of UVixie. Good stuff. Wait for the jobs report to close. They already announced that at 8:30. There's no more reports coming out. What's the poor man's cover call? Poor man's cover call is when you sell a cover call against a Leaps option that you open. So, for example, since I own this $160 Leaps for GLD, that basically gives me the right to buy 100 shares of GLD at 160. So since I have that right to buy 100 shares, that also gives me the right to sell 100 shares as well. So say I end up selling the 180 strike price, expiring in, 45 days. 42 days is the best we can get. 180 strike price, we get paid $118 a credit. You would take the difference between your strike prices, 180, the one that we're selling, minus the one that we bought, which was the 160. So a $20 difference there. And then you add the credit that you get, which will be 115, so 2115. And you want to make sure that is greater than, I think, the debit paid, which for this case, let's see. This case, we would take a loss on it, since the debit paid of $31.25 is greater than the difference between the strike prices plus the credit that we get out of it. Right, so we would lose our Leaps option. Then we would take the profits between the difference between the strike prices of $2,000, and then we get to collect the $115 in credit if GLD is above $180 by my expiration, which was 42 days out. So you want to make sure that the difference plus the credit is greater than the cost for your Leaps. Do I dollar cost average into financials? No, I would not do that right now. I would be worried about financial stocks just because of the rising rates. Less people are going to be borrowing money to buy homes, auto loans, and things that, generally yield the banks a lot of money. If the APRs are going up too quickly, people are going to hesitate to buy homes, cars, and high price items. So I think that banks still have a good ways to go down. And that's why I bought that Bank of America Leaps put option, was because I think that banks are going to have a tough next couple of years as long as interest rates are as high as they are, because we've had, the last decade of 0% interest rates, and then we had COVID hitting and a ton of liquidity flooding into the market. And now that liquidity is being drawn out of the market, and now you have, 5% federal funds rate. The 30-year mortgage is roughly 7%. New cars, I think that the interest rates are something along the lines of like 6%, if I remember right. And then used cars are like credit cards, basically, at this point, at like 12, 13%. So people are not going to be buying as many vehicles, buying as many houses, whenever interest rates are so high relative to how they have been for the last decade. So I think that banks might have some trouble ahead for them, personally. And I wouldn't dollar cost average into XLF. Nice little rally today, though. Making my way back above the 31,000 mark. So glad to see that. Took a lot of profits today. And SPY is coming down to that trend line again at 388. So maybe we can get that call debit spread for the 14th a little bit cheaper now that it came down a bit. Let's see, assuming that it'll go back to 393 at the 200 moving average. We are paying now 44 cents. That's better, I would say. I would still want to get these at like 40 cents or less if we can. But right now we're just not getting that. Just not possible. We could go one strike price higher, and I'm sure we would pay less. Let's see. If we go with the 393, 394 strike price, we pay 41 cents. I'm hesitant on that, though. I still think that's a bit much. So I might not open any new trades today unless I can find a different opportunity. I would say coming back to the Fibonacci level at 380 could be possible, probably maybe over the next, I would say I would give it more time, like 5-6 weeks is possible. So maybe for the April expiration date on the 21st, assuming SPY will go down to 380. With the VIX up right now, we're probably going to pay more for this option than we usually would, but currently this option is going for 35 cents, 33 cents actually. So not a bad opportunity if SPY does continue to come down. We have seen a lot of just sideways price action. I think that it's mostly due to the 0-date expiration options and people buying calls and then buying puts and then flip-flopping between them. I think that's really kind of creating the dynamic of intraday volatility, which means that there's no longer-term volatility. If we do start to see more of these banks going down, I think 380 could be in play by April. And then if we go to the May expiration date, 380 strike price. That one, we're paying 36 cents instead of 33. So it's only a few dollars more for an extra month's time. The problem with that, though, is that the implied volatility goes lower the longer your expiration date. So whenever SPY does end up going down to that 380 level, you're not going to get as much value out of it as you would if the expiration date was closer, like a week out, because more people are buying into weekly, daily expirations than they are into, monthly expirations. So that does mean that you get a discount if you're buying these, which is good. But with the VIX slowly making its way back up to 24.40 right now, you are going to start to pay more for those options. So I think I'll buy that 380, 381 put strike price for March 17th, going for 30 cents right now. I'll probably risk the usual 300 is what I put down on these on average. And right now the bid is fluctuating on me, but I might be able to get them at 30. All right. I might have to pay 31. Oh, no. I got it in at 30. Good stuff. And then I'll probably hedge with a shorter expiration date, assuming that will go back up. But I need to find a decent strike price first. New options alert. This is a swing trade. I've been taking a lot more swing trades recently just because they've been more profitable for me. Just opened a new SPY put debit spread expiring. Expiration date is, oh shit, I chose 3/17. That's okay. 3/17 at 0.3 each. So I'll have to close these pretty soon. I meant to choose the April expiration, but I will add that. 380, 381 strike prices. So let me add on the April expiration that I meant to choose, which is April 21st. And those are actually going for like 5 cents more. So we'll pay more for it, but I think it's worth it for that extra time. And I actually got them at 340. Good stuff. New options alert, swing trade, premium members. Just opened a new SPY put debit spread expiring in April 21st at 35 each. And I'm assuming it's going to go to 380 again. And then I'll try to get out of those shorter expiration 3/17 expirations pretty quickly. Hopefully in the next probably couple of days, this might end up being a day trade. I'll probably just cut losses as is, just because it was a mistake trade. I opened 10 of them. Still trading below 50 RSI. I would say as long as we stay below 50 RSI, I might hold these. Would I consider opening a strangle for FOMC since the market is somewhat split right now? I think that the FOMC is going to be bearish either way because of their summary of economic projections. Even if they do a 25 basis points, that's already priced into the market right now. And they're going to release a summary of economic projections with that where they estimate where they expect rates to go in the short term for this year and for, the next 5 years. So I think that it's going to be bearish either way. They're going to keep rates higher for longer, which is the narrative that they've been pushing. So as long as they stick with that narrative, I think that it's going to be rough for the markets either way. Whether they do 25 or 50 basis points, I don't think really matters. So I would take the bearish side on that trade. But, considering we're already trading at 390 right now, there might not be a ton more downside to expect, especially with that trend line acting as a support right now. We'll have to see. Then if we check in on KRE, which was the main focus this morning, this one is still down 3.5%, but definitely recovering from the heavy drop this morning. The VIX is just ripping everybody right now, up another 7-8% today. So people are piling into those monthly puts more and more. The 10-year is down to 3.7. So that means that more people are buying up the 10-year treasuries. Even at 4%, it's a decent deal, but I would rather take on the shorter end of the yield. The 3-month, the 6-month, the 1 year, and the 2 year are all paying 4.5% versus the 10-year paying, 3.7 right now. I would be more enticed with the higher interest rates if I were a money manager managing millions. But I don't have enough money to make a real difference buying bond yields, so. All right, I think I'm just going to have to close out of these at 25. All right. That 390 level is just acting as a resistance right now. Still below 50 on the RSI, so I could hold these, but I'd rather just get out. Get out while I can with that short expiration. What do you think of 3-week out Iron Condor for Ulta? Good opportunity to collect post-earnings IV crush. Yeah, possibly. I think that it's, at will of the market. So the market keeps going down, then Ulta would go down with it. And then if the markets perpetuate up, then it'll follow along. So I would keep an eye on, the overall market and use that to judge where to get out of the trade. But just cut the losses for the mistake on the 317 expiration. I can't choose the damn right screenshot. There we go. Closing. Jesus. Closing. Options. Alert. Premium. Just cut losses. For the There we go. Sorry about that. And back. Looks like this one got disconnected up here. But we're back in. Should be unmuted now, hopefully. But yeah, that's all the trades that I think I'll make for today. I might make some later on based on that trend line down below. If we go below it, I think we could take the upside trade later on in the afternoon. But for right now, it's all the trades I got for y'all, and I will catch y'all on Monday at 9:30. See everybody.